So you invented a drug for, let's say, weight loss and diabetes, type 2 diabetes, something like Ozempic. Nobody can come and produce exactly the same thing, even if they could reverse engineer the formula. But if you acquire these intangible assets by paying money, then you can attach value to them. So, I mean, think about it, corporation like Pfizer. Do you think all the drugs that they sell have been invented in their own research facilities? No. They buy stuff all the time. They buy the patent. Sometimes they just buy the patent, they don't even use it in order to prevent the competitors to do the same thing. But it has value. And there are also some tangible and non tangible assets. For example, you guys heard a person called Steve Jobs, right? Uh, Steve Jobs is one of the three founders of Apple. The other was Paul Allen, uh, who's now the owner of two teams in Seattle area, I think, the football team and the basketball team. The Woz, Steve Wozniak, and Steve Jobs. Paul Allen and Woz left Apple. It was only Jobs left. By about 1995, Apple was on the verge of bankruptcy because they had only one horse. That was the Macintosh. It was a superior personal computing experience, but you know, marketing is a different thing. So PCs pretty much took over that market, and Mac was struggling. They fired Steve Jobs. By 1999, they said, "Okay, we made a mistake." They hired him back, and within a year, he invented, not invented, but he came up with the idea of the iPod and iTunes, then iPhone, iPad, what have you, all of those things. And suddenly, Apple became the most valuable company. They even surpassed Microsoft. I don't remember the exact year, but I think it was 2012 or something. Apple announced that Steve Jobs was diagnosed with terminal pancreatic cancer. Pancreatic cancer by itself, especially those days, has a 5% 5-year survival rate. Do you know what happened to the Apple stock that day? It tanked by about 10%. And Apple was worth around $1 trillion those days. That meant, as far as market was concerned, Steve Jobs was worth $100 billion. But you look at uh, financial statements of Apple, there is no item called Steve Jobs. Why? Because accountants are a conservative bunch. If they don't have means to attach a value to something, they don't. It's zero. It's not even listed. All right. Oh, there is also one intangible asset that you may see. It's called goodwill. Okay. They're not the stuff that they keep at the goodwill stores, or it is not about a value that is attached to the social goodwill towards the company. It's kind of a misnomer, but it is there. Back in, I think, 2004 or 2005, Google made, as far as I remember, the most valuable acquisition ever in the corporate finance history. Okay, they bought YouTube. YouTube was not invented in Google, and at that time they didn't have a single dollar of revenue. There were just a lot of cat videos on that platform. There still are, but now there's a lot more stuff. And they paid $1.6 billion for YouTube, for a company that had no revenues. But they had a lot of financing too, so they had assets. In order to do all of that, you have to have server farms, yada, yada, yada. If you looked at the books of YouTube, it was worth about $500 million. All right, half a billion. So basically, that's shareholders' equity or net asset value was $500 million. But you paid 1.6. Remember, in double entry accounting, everything has to add up. So as soon as I spent 1.6, okay, uh, that reduces my net income, which in turn reduces my retained earnings, which in turn reduces my total equity. So right hand side went down. So left hand side has to go up for the balance sheet to balance, right? So you put $500 million as the value of the assets from YouTube. What's going to happen to that 1.1 difference? You have to put that somewhere. It's not a loss. So you create kind of a, we call that these sometimes contra accounts. The contra account, we call it goodwill. It is the value that is in excess or acquisition value that is in excess of the book value of the acquisition. And cost of acquisition over and above the book value of acquired assets. And the rule for this in the old days until I think 2006 was that you had to amortize this over 40 years. So if you looked at financial statements of Google in 2005, you probably are going to see some amortized goodwill as an item if you have details. But in 2006, FASB, which is Financial Accounting Standards Board, it is different from FSB, which is the modern version of KGB in Russia. Sometimes I call it FSB, but because I view some of their rules pretty rigid. Uh, Goodwill was subject to an assets impairment test, which means at the end of each financial statement period, you ask yourself this question: is this asset still worth at least 1.6? Okay. If it is, you don't do anything. But if it is not, you make an adjustment. The most famous example of that is another acquisition around that time that was considered a wise acquisition. Do you guys remember or know of MySpace? It was Facebook before Facebook. Okay. Now it's you can find any child predator or the darkest things you can find outside of dark web. That's in MySpace. But at the time, it was a big thing. And the Fox Corporation thought the same thing as well, and they told Wall Street Journal, which they own, to go ahead and buy this company. They viewed it as a kind of a media asset, which it is, social media. They bought it for around $500 million. Of course, about 2 years later, Facebook came about. By 2010, it was obvious that MySpace was no space, and all that goodwill had to be written off. That's what asset impairment is. Other than that, fixed assets are booked at historical cost minus any accumulated depreciation, if there is any amortization, depletion, what have you. A lot of fixed assets are physical assets, and they are subject to depreciation rules. So if you buy a computer, as far as I remember, it is subject to 3 years makers. It's modified accelerated cost recovery systems, which means you can write off to 33% in the first year. I think about 40 or 50 in the second year, something like that. So by 2 years after I bought off this thing, I have already written off, let's say 80%. So I bought it for $1,000, but I have written off $800 in depreciation. That is not a cash expense, but as far as the accounting is concerned, the value of that has been reduced. So now I list that at $200. That's why we call it net fixed assets. It is net of any such depreciation, amortization, and stuff. Depletion typically refers to how you do depreciation for natural resources. For example, if you have a copper mine and you think there's 10 million tons of reserves in there, if this year you took out 1 million, 10% of the original acquisition cost is your depletion cost. If you took out 2 million, then 20%. Similar stuff apply to commercial vehicles like trucks and stuff. They have certain tax lives associated with them. It's typically in miles. So if a truck has 100,000 miles of tax life and you use that truck for 30,000 miles this year, you're going to write off, 30% of that. Then we have that part is also called statement of shareholders' equity. It starts with capital stock. This is the so-called capital plus paid in surplus. Let's say a company has 1,000 shares, and companies attach a nominal value to those shares, and they say these are $1 each. Okay, if that is the case, the capital amount is, or the common stock, actually, I should say,